you've been covering the distress that we've been seeing. Can we just start by talking about how much there's been so far this year?
So in November, we saw the supply of distressed debt hit 126 billion. That's the highest since about August 26, or the most, excuse me, since August 2016, and really the highest of this cycle. But sort of historically speaking, that's really not that much in the grand scheme of things compared to, say, the financial crisis or even the highs of the oil crisis. So it sort of shows you that we're heading back up to that high, but there still isn't a lot out there.
Well, what's interesting to me is that in 2016, you had oil prices tanking, and a lot of the distress was in the energy patch. Again, we see issues with energy this year, even though oil prices didn't go down all that much. What went so wrong, and for whom?
Yes, so what we really saw this year was a lot of very idiosyncratic or company-specific situations. We've had oil prices stabilize in the $50 range, but for many companies, particularly those with very high debt loads, very high leverage, that's simply not enough to keep going. And we've seen them run into covenant issues, maturities, and also creditors who are just kind of tired of giving them more time.
And meanwhile, some of these big private debt companies are increasingly taking over for Wall Street. Lisa, how are the likes of Apollo and Blackstone plowing into Wall Street's domain?
Well, they've been in lending for quite a while now. But what's really changed is that there's just been a flood of cash into private credit, into direct lending. So they have bigger pools of capital to have bigger hold sizes and really eating into the market that was syndicated market.
All right. So how are they eating into Wall Street's underwriting business with leverage loans?
Well, they're doing deals at size at 1.8 billion, 1.6 billion. Deals that could have gone to the syndicated loan market so that Barclays or Goldman Sachs or CS might have arranged and sold to institutional investors. And direct lenders are just taking those deals away at the moment.
All right. And how much could they end up taking away from public markets, some of these Apollos and Blackstones of the world?
We're seeing a real emergence of a new asset class that's going to rival leveraged loans and high-yield bond market. So Apollo suggests that as much as 10% of the high-yield loan and debt market could go private in the next 5 years. That's a huge amount.
Yeah, and it brings up a lot of questions about the potential risk that gets embedded when you do have more of this business moving to private firms that focus on private debt, which brings me to Jason. And as we talk about risk, regulators are focusing in on private markets, but how to figure out ways to open them, not necessarily close them down or shut down risk. How is the SEC trying to democratize private debt and equity?
Well, it's a great question. And here in Washington, Lisa, they are looking at ways to make the pool at least a little bit bigger. This is a holy grail of sorts for the big private capital managers. They want more people to give them money, put simply. The SEC widening it just a bit, potentially, to say if you have certain certifications or if you are knowledgeable about the market by working with one of these financial firms, maybe you too can be an accredited investor.
So why? Why does the SEC want to open up the market so much?
Well, they've gotten a lot of pressure, candidly, from the firms themselves, but also there's this sense that everyday investors, or at least a broader scope of investors, are missing out on a lot of the gains and the profits that have been made in the private sector. You think about the gains that have been made on companies, say Peloton. Once they go public, those private investors, they look much better and more profitable than maybe the public investors. In the age of the unicorn, people want more access.
Yeah, although more access, but also this is inherently risky. And not only is it risky in terms of the actual investments, but it's risky in terms of the maturity profile. The fact that a lot of these investments don't really come to fruition for a long period of time. They're not that liquid. So what are the risks here?
Well, the risks are big, as you point out, and that's why we're here to some extent talking about this, why it hasn't happened before. The SEC is meant to look after investors and to keep them away from things that are, as you say, a little more risky. This is an opaque market in many ways. It doesn't have the transparency that a public stock market would, and people do lose money. And so you worry about folks going in to these investments not having the sophistication that maybe a professional investor would.